Hello, this is the Two Guys, One Book podcast. Me and Izzy here in the same room today, special episode. Um, as you can see on Izzy's screen, we are both drinking some screwball today, courtesy of my freezer.
On this fine Sunday afternoon.
Yeah, it's a beautiful day out to be in America. This is March 19th. Approximately 9 days after the SVB financial crisis.
Yep, and just like 2 days after the UBS announcement of the possible consolidation, right?
Yep. And just also, a few additional days after Credit Suisse requested a $55 billion US dollar loan when you convert like the Swiss franc to US dollars, which, to put that in perspective, the illustration I've been using the past little while has been the Bill and Melinda Gates Foundation, which I'm a personal fan of. It's sarcasm. Um, it its total asset value, its net worth, was $55 billion. So Credit Suisse has, in effect, requested that the Bill and Melinda Gates Foundation liquidate all their assets and then hand over all that money in cash. Just showing you how unrealistic that large of a loan is.
Yeah, and the fact that their valuation, I think it said that their book value or sorry, their market value is set at $8 billion, which even that, I think from the Wall Street Journal, even I think the word it used was the verbiage was it's a modest $2 billion was a modest asking price for Credit Suisse, and I'm like, well, Credit Suisse isn't really worth much at all right now, especially given the fact that they have like virtually no cash in the bank. So how are we valuating our banks based on, like, if we're not valuating banks based on what currency they have available for disposal, and they don't have any of that. I think there's a rule, I forget what the term is. It's basically where you have to have a certain amount of cash essentially in the safe to be able to get, I think it's like 20% or something, to be able to pull out when you compare to your total amount of like virtual money in the bank. So at least that rule applies for commercial banks. But at the end of the day, like 8 billion is not accurate. It is not worth 8 billion, unless you're talking about imaginary IOUs, then sure.
And I'd also like to add on to this. And I don't exactly know what this means. I've honestly been trying to figure this out the past week or so. And you would probably be a good person to ask, being the finance guy out of the two of us. But Credit Suisse, I'm looking here on the macrolist.com. And it essentially is saying, I'll send the link in the chat and share my screen here. Let's go. So you can see my screen, correct? Credit Suisse has $39 trillion in derivative debt, which if we go US national debt, we're at like 31 trillion, 31.6, I want to say. Yeah, 31.6. So Credit Suisse alone has more derivative debt than the US like federal government has debt, which is pretty bad. And as far as derivative debt goes, because I've been trying to figure out what this means. Like, obviously, derivative debt isn't the same as normal debt because, as far as I know, derivatives are some sort of stock index. And typically a derivative is also leveraged on whatever like assets the index is tracking with. So if like you wanted to track the NASDAQ, for example, that derivative would be, if the NASDAQ went up 5%, the derivative would go up 20%, because it's like typically a 20-to-1 leverage. And same thing, if the NASDAQ went down 5%, your investment would go down 100%, 5 times 20. So I was hoping to get a read on what you thought about what this derivative debt is. And but maybe before we do that, we should tell our listeners, our watchers, why we're talking about this right now, other than it's, happening right now as we're living on the planet.
Well, I guess the why, before I lose it, I will kind of talk real quickly about what I understand about derivative debt, just before I lose this. I know that most of the time it's used to hedge risk for the most part. Like for example, like an options contract, that it would give you, essentially, you're getting, by handing out an options contract, you're giving the holder of that contract the right to buy whatever underlying security is listed on that contract. But you don't need to. You just have the right, you have the opportunity to. So generally, it's used for those kind of commodities that have very volatile price indexes that kind of just swing really wildly. You want to use derivatives to essentially hedge that risk. And you're doing so by not obligating the buyer to have to buy. You're giving them an option. It's an options contract. So that's kind of what I understand about it. And they, because essentially what they're doing is they're locking in a price for whatever underlying asset or security that it is you're buying. That's the advantage to it. So that's that.
Could I ask a question real quick?
Yeah, sure.
So just to clarify, would it be fair to say that $39 trillion, it is $39 trillion of options, essentially, that the investors own? So Credit Suisse has, I guess these indices on certain assets in the stock market. They're turned into derivatives. Investors buy these options to buy derivatives at a certain price. And so technically right now they don't owe 39 trillion to their shareholders, but if all the shareholders decided to cash out on their right to buy price, they would have to fork out 39 trillion.
Right. But again, that amount changes over time because of just the nature of it, because it's, if the performance of the underlying commodity or the underlying asset is not doing well, if the performance is on a downstream, it's kind of going down, then at that point your derivative, I guess, debt would go up, because as the initiator, as the person responsible for that contract, for issuing that contract, if that security, or if that excuse me, if that entity is not doing very well, then that amount can vary. And again, if the price moves up, and and the actual commodity is doing well, again, very volatile commodities for the most part, but if it's doing well, then at that point your derivative debt goes down, because now your contract is essentially, you're making more money off of your contract than you are losing. But right, if you do, from my understanding, if they did cash out, then Credit Suisse would be unable to essentially liquidate that. They wouldn't be able to provide that money. But I mean, generally, again, another thing we got to consider is most of the times these things are not cashed out. It's more of it's a long-term asset. You want to hold on to it for quite some time. So people aren't generally very prone to cashing out. It's almost like buying a T-bill. Like, you're not going to buy a T-bill. It's just like a very more risky T-bill. But if you're buying a T-bill, you don't want to cash out necessarily. You want to hold on to that thing. So that's probably why they haven't had too many issues with that number, just because of the fact that people aren't in a panic. It's very different than, let's say, like your actual checking account money. Like if you have millions in your checking or in your savings account, and you're not able to pull it out. That's a lot bigger of a concern for kind of individuals as opposed to this sort of derivative debt. So
those are some important things to know about, I guess, our knowledge on derivative debt. Here we have a chart measured in millions of dollars. So as you can see, is Credit Suisse even on here? Credit Suisse is not even on here because, well, they should be. I'm not exactly sure where they are, but we could see similar numbers coming from like the big four banks, for example. We see JP Morgan and Chase. They have $52 trillion in derivative debt, and they have $3 trillion in assets. Not a good ratio. Just if I were to look at this from face value from 50,000 feet up, I'm sure there's a lot more under the hood of these numbers, but like same with Goldman Sachs. Like
well, isn't that saying that the derivatives? That's not saying derivative debt, right? That's saying the actual amount of essentially options that they have dealt out. That's a combined amount of derivatives in terms of the option value. So I think that's what it's saying. I don't think that it is. I mean, it has total options, but I think that's the contract itself. I think derivatives, that's not the debt, I believe.
interesting. Okay. Well, that is a good thing to
I
know.
mean, I may be wrong. I may be wrong, but I think that that is not necessarily debt because it doesn't say. It says just total derivatives there.
Yeah.
So
That's a good thing to know. I suppose we would have to really kind of investigate like what this table one means. But it is interesting to me that like even if this isn't just debt, if it's like okay, some of this shareholders like owe money to JP Morgan and some of it JP Morgan owes to its shareholders, like the maximum amount of money that JP Morgan could like owe essentially their creditors, the people who bought these derivative contracts, would be 3 trillion. And it doesn't seem likely to me that only they like JP Morgan is like making money on all this 52 trillion, right? Um it seems likely to me that they owe their shareholders, like if we just say they're 50% hit rate on their investments, and the shareholders owe them $25 trillion, that still leaves like $22 trillion kind of that JP Morgan owes their shareholders based on their derivative contracts that they sold. But we're getting into the weeds here for sure. Stepping back into why we're talking about this. So with the rate Izzy and I have been reading, we're on chapter 3 and 4 of Ray Dalio's Principles for Dealing with the Changing World Order. And chapter 3 is titled The Big Cycle of Money, Credit, Debt, and Economic Activity. Chapter 4 is The Changing Value of Money. So Ray Dalio, in these like 2 chapters that we're reading, that we're going to go through probably over the next few weeks, going to spend a few episodes on this, are directly about this, and it's crazy how this timing worked out, you know?
yeah. I think the last thing about the uh just whole derivative, weed conversation we got into, getting into the weeds there. Derivatives, the last thing, just for the listeners out there, just obviously do your research on it. Don't take everything here for law, but derivatives can be either liabilities or assets depending on what it is tied to. So generally there's underlying assets that are tied to whatever derivative, so it could be classified as either a liability or an asset depending. So that's the last thing I'll say about that. But yeah, these next few conversations are definitely going to be more financials driven. But again, I don't work in banking, so at the end of the day, even my understanding is a little bit jaded now, from my work experience. So we're gonna definitely, dumb it down, and provide our screen share and everything, so you guys can kind of take the ride with us here. But I know for sure, if you don't already, definitely keep up to date with the Wall Street Journal. Definitely a good news source when it comes to all things banking and finance. So
For sure. So I don't even know like how to get started into this other than like
Let's talk about tax season.
let's talk about tax season.
tax season. I
So-
paid my taxes. Have you?
I have not.
Should probably get on that.
Yeah, I probably should. Okay, so I'm a little behind, but
Just so everyone knows, taxes in the United States are due typically April 15th unless you've filed for an extension. So if you haven't done your taxes, it's coming up soon. Probably should get on it just so you get your ducks in order, you know?
yep. And I will say, I was talking to a buddy of mine from Truist. He works at Truist, and he's on like the corporate finance side, and he was telling me that like we were kind of talking about taxes. He's like, "Oh, I haven't filed mine." I was like, "Oh, me neither. We got to get that done." And the joke was, yeah, like, will the United States be able to actually give us our returns? And I told him, I was like, are we gonna get our returns? And he was like, well, we shouldn't. Like, we shouldn't get our returns. Like, where is that money coming from? Like, they're paying out. They have all these issues going on right now, and then the fact that, realistically speaking, if this was a healthy economy, then generally this would be something where it's a deferred repayment, because the United States should not be able to afford handling all these tax reimbursements. And the second joke was, yeah, go ahead and tax me 100% and give it to Ukraine. That was the second joke. So
Yeah. I mean, so as far as I know about the US like balance sheet, I guess you could say, is I haven't gone out and verified this information. This is just from a podcast that I listened to this morning. But it was that the US takes in about $4 trillion of taxpayer money each year, and each year the US spends about 6 trillion. So we're seeing about $2 trillion somehow get paid out, and I assume that 6 trillion. Well, I don't know if the tax return technically counts for that 6 trillion, or if it's more like the U.S. government was about to receive 5 trillion and then they reimbursed 1 trillion to get their total return or the total income of 4 trillion. You know what I mean? So I don't know if the U.S. government operates like that, or if they're just gonna take all the taxes that we pay them, spend it as they see fit, and then we have to make some returns, so let's go to the Fed and ask for more money, you know.
yeah, and luckily that's gonna be the case. I will say that they are cutting out. I think the average refund should be lower this year, just given the fact that a lot of those kind of pandemic kind of boosters that were kind of thrown in there are being eliminated. So, which is for the best. They should have been eliminated a long time ago. I don't know why it was continuing through 2022. It makes absolutely no sense. But I will say that it said the average tax return in 2022, so the 2021 tax year, from what I'm seeing here on CBS. So accurate for sure, um, is $3,200. So, um, you could do the math on your own, but that per adult in the United States is quite a good amount of money. And at the end of the day, even if we see a 20% drop in our actual tax refunds, um, we could do the math right now. Let's see how many. Okay. So we're at 249 million. So just around 250 million. So 250 million times, what would that be? Let's just say $3,000. That's a $750 billion tax refund.
Yeah, I came up to 960 billion, but I did 3,200 times 300 million. I figure
Okay, yeah,
it was
okay.
about the same, but 700 million or 700 billion to about $1 trillion is how much the US government is going to have to reimburse. So, the analysis I gave just a second ago of, okay, we pay $4 trillion. Technically, we pay $5 trillion before our returns. Now the US government is going to take about $1 trillion off the top and give it back to us.
Yeah, but they're not going to give as much, right? Because, yeah, I just don't know how it's going to work out, to be honest with you, with all the outflow going to Ukraine and the issues with the banks as well. Like, I think I think the climate has changed a lot over the past year. I think that a lot of households and individuals, which is, the backbone of the country, of any country really, has really lost a lot of faith within our banking system, and not only our banking system, but within the government's ability to essentially convert our tax money into a tactile. The whole point of taxes is, yeah, we get a little bit of money back, but the primary return on our taxes is within our own cities. That's the primary return, but all this money is essentially going to um, the military for the first part, for sure, which I can get behind that a little bit more now, just given the fact of, current global climate. But it also goes to a lot of other things that it shouldn't go to, and you don't get like when you make a payment and get an itemized receipt at a restaurant. Honestly, in my mind, I think that I think that they should start kind of itemizing how they repurpose tax money, you know? Um, but, we can only wish.
And so just to throw another wrench into that, obviously, so what we don't happen, obviously, is we don't want the federal government printing out $1 trillion to reimburse us, because then if we think about the mechanics of inflation, the way I think about inflation is a little bit different than the way Ray Dalio explains it, but it is essentially the same. You think about the return on cash, right? And that's at its core, return is like present value times like one plus the interest rate minus the inflation rate. And so as you are like printing money, when you print a dollar, you're adding a dollar into the monetary economy, right? But the real economy hasn't necessarily increased in value. So that monetary economy is kind of the denominator, right? Over the real economy is the numerator. So if you add a dollar to the monetary economy, suddenly the real value of the economy is split across more and more dollars. So that is why each dollar becomes worth less as we add more money to the monetary economy. Is that fair to say?
Can you add in that last part one more time? I'm sorry, I'm just trying to.
So when you print $1 trillion, for example, let's say there's $1 trillion in the monetary economy right now, for $1 trillion of the real economy, just meaning real value of like concrete goods, services, assets. So that's 1 trillion over 1 trillion, right? And so that's $1 is worth $1 in the monetary economy is worth $1 essentially in the real economy. But when you print $1 trillion more dollars to represent the same real value of $1 trillion in the real economy, now suddenly you have $1 of real economy for $2 split between $2 of the monetary economy. So that numerator of real is the same, and then the denominator is doubling when you print $1 trillion if there's $1 trillion in circulation. So it's my whole thing is essentially when you print a dollar, your each individual dollar already in circulation is becoming a little less valuable in terms of exchanging it for real goods and services.
Yeah, I think that's about right. I will say, there are other factors involved. Because I know one big part of, at least when it comes to debt, which is one also, big factor when it comes to how much our economy is actually rotating money wise, is also partly to do with our debt, um, which is tied into bonds, which is tied into who we owe when. So I agree with your statement. I just think that there is more, and it's super 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 in depth, and that's really deep in the weeds as to the why. But I think overall the statement's correct. I just think that there are, I'm sure that too, there's a lot of other factors kind of at play here as well. Because I was actually just looking at this article by CSNBC. Can't hate them. But they claim that it's definitely a pro-Democrat statement here, but it's saying that the House Republicans are trying to raise the debt ceiling, which will hit its $31.4 trillion borrowing limit in January. And they want to essentially, the Republicans in the House are essentially trying to cut spending on social programs and some other things, and to prioritize who they pay with this increased debt ceiling. One of those parties of high importance is China. So
Yeah,
they're essentially wanting to pay them out. And it's funny because I don't know how accurate this is. I always thought that our debt to China was a lot more than this is saying. But it's saying right now that China holds about $1 trillion of US debt, which is, it says, about 3% of all US debt outstanding.
that seems right. If you think about 1 trillion over a denominator of about 31 trillion, that checks out.
Yeah.
3%. As far as I see debt in like a very simple model of the economy, is debt more or less is like deferred payment of things in the real economy, right? So it's to me, debt kind of determines like how much money needs to go somewhere when, right? That's essentially the core of it. And so in the modern US fiscal policy, it's kind of like, okay, how much money do we need to print when? Is as kind of like a dark way of looking at it in this real economy over monetary economy model that I've laid out.
Right. And I think another big piece of it is also, I was just kind of looking at it in terms of like just a generic balance sheet structure. And the way that that is obviously the golden formula: assets equals liabilities plus stockholders' equity. So your assets should equal all of your liabilities, all of your long-term and short-term debts, all of that, as well as in terms of the United States economy, like our outstanding T-bills and bonds.
So that is another factor. Like all the debt in the world should not add up to more than the value of the goods and services in the real economy, or else that is a very interesting place we're in. And honestly, I kind of feel like we're nearing that place, and that's kind of why all of our like our major debt holders, like these banks, are kind of struggling to pay their creditors, right?
Right, and I think another big part of it is the fact that, like, as you know, when we hit our debt ceilings, the government cannot issue bonds anymore when we hit our debt ceiling. Um, Reason being is because they do not have the ability to the best of my understanding, comfortably pay back that debt.
And so a bond, just for my sake of understanding, and this is like the government issues a bond now for, let's say, $1. And essentially, when you pay that bond, you pay $1 for it. And then when it matures, then you get $1.10, right?
Right. A bond is essentially, it is more like a loan than it is a stock. So, yeah, the government is asking you for $1. They are issuing bonds for $1, which is basically saying we are trying to collect dollars from from whoever wants to buy them. We will give you this set interest rate that is predetermined on that note, and you essentially generally you have, I forget what the time for maturity is, but you get that interest back as well as the principal, um, for that loan that you have essentially given the government. But the only reason why it's called a bond and not a loan is because obviously, as an individual, you're not reaching out to the government, issuing a contract and loaning them money. What is happening is they already have predetermined contracts that are already set with set interest rates, and they say, we are willing to, if you're willing to loan us money, we have this note for you and we will pay you back. So it's just interesting because, there's a lot, I think a lot of people are not um, very, they're not encouraged to get bonds at this moment in time because of that risk that people see with our ability or inability to repay said obligation from the government.
With non-printed money is, I think, the big asterisk there, because the benefit of the bond, right? As far as I'm aware, typically investors and banks and everyone likes to buy bonds when interest rates are rising, because if the interest rate is 10% and you buy a bond and let's say it matures in 5 years, then you're going to receive 10% on your initial investment in 5 years. However, that's with zero inflation. If the government is now printing money to repay the bonds that they sold you 5 years ago, now we're kind of roaming into territory of, like, how much is that bond actually earning you? And that's kind of the place we're at now, it seems like.
Yeah, and then the one thing that's added in there is you're earning, again, that same example, 10% over 5 years. You're earning, as the person who bought the bond, you're earning 10% of the principal that first year, 10% of that principal, and that additional interest the next year. It's what is it? Com What's the
Yeah,
word?
it's
It's
compound interest.
compound interest, right? So, and the formula is pretty. It's a long formula. I remember it from school, but it's pretty much, there's a par value for the bond, and you can adjust for inflation, but at the end of the day, inflation, the whole advantage to bonds is the stability factor. That is why people buy bonds. Generally, interest rates are not very high on them. So you're getting a stable return over time. You do a 10-year bond, you're you have no risk of, like in a stock, if you're purchasing stocks, there's always risk involved. And even more so if you're delving into kind of the cryptocurrency realm, it's even more volatile. So the whole advantage is stability and assurance of repayment.
The faith and confidence of the US government.
Right.
Isn't that magnificent? A
Right.
magnificent statement. And you know, the I'm sure you've been hearing a lot about the FDIC the past couple of weeks, and the FDIC is it's pretty funny. backed fully by the faith and confidence of the U.S. government. That's your deposits are backed by that, not by gold anymore, not by petro even anymore. Now we see Saudi Arabia just signed a contract with I believe China that was like, oh, instead of paying, like forcing everyone to denominate the oil and pay in US dollars, now we see Saudi Arabia saying, yeah, whoever we sell oil to, we're just gonna sell in that nation's local currency, and then they're gonna do what they want with it. Maybe they're gonna convert it to US dollars, maybe they're gonna go buy gold, maybe they're gonna invest in stocks. Who knows? They're probably not holding that currency though. That's something I will say.
Yeah, and also it's been a very interesting trend you've been seeing with Saudi Arabia for the past few months now. I think that they've started to, because for a while they were very buddy buddy with the United States and almost preferential towards their treatment in the United States when it comes to transaction on the transactional level at least. But now we're seeing them kind of in a weird way. I don't know how else to explain it, but understand their level of authority here and how much sway they have on prices. And especially, I remember, like, back when the gas prices were ridiculous. I think when Biden first took office, um, even I think that was a sign for them that, hey, we have a lot of the world kind of almost in like a little triangle choke here. We can kind of do and adjust our prices, and we have no obligations to anyone. I think is what they realized. And at the end of the day, I mean, yeah, it's good for Saudi Arabia and their economy. They're doing really well for themselves, but um, I think honestly, when in that sense, I think it might be best for the United States to start, in general, delving back into our own natural resources, delving back into our own. Because that was one thing that I listened to a podcast. Dan Carlin, by the way, for everyone listening, excellent podcaster. One of my favorites, if not my favorite guy to listen to about anything. He could be talking about rocks and I would be invested. Um, but he was basically talking about how the United States, come World War II, the thing that set us apart from the rest of the world was not our military. Our military was very lackluster at best. It was okay. The issue, the thing that set us apart was our industrial potential. We weren't fully, we were very, very, very self-sufficient. We were foods. We had a food security. All food was pretty much made in the United States, and we could go back to that. That's not like a thing that we can't go back to. Yeah, people in California would be kind of pissed off they're not getting their avocados, but we would be doing okay. But the issue now is that our manufacturing is not here anymore, and our banking systems are having a tough time because we're so reliant. A lot of the time it's because they diversified so heavily into international markets that now we cannot liquefy that money that we've invested. So that's what a lot of those also derivative debt is coming from. And I'm sure you can dive into that, and that has to be from international, basically buying international like options pretty much. And that's something that's like very risky. But yeah, either way, back to the point. The United States needs to kind of go back to that kind of stage of self-reliance, and just overall self-sufficiency. Because right now we could just see, just with Saudi Arabia, like the fact that we are relying on them so heavily to set the prices of oil, set that price ceiling. That is very risky. It's very risky, especially given the fact that we're not like China and we're not like fully, you know, an electric car country. No, like we rely on gas for a lot of things. So yeah, that's my point, I guess.
Yeah, and it's interesting that, like, Saudi Arabia at least has a lot less faith and confidence in the US dollar, and that's kind of why they seem to be kind of isolating themselves in a way. Like, they're still participating in the global economy, obviously. That's why they're still selling oil globally. You mentioned that, Saudi Arabia is kind of in it for themselves, and uh Saudi Arabia, like, besides oil, really kind of needs to depend on the global economy, and that's kind of where they're weak. And what you were making the point where the US is strong. Like, we have a bunch of natural resources back home, like food and oil and stuff, and we don't have the manufacturing that we once did, and unfortunately our banking system is not in a place that seems to be able to fund any like bringing the manufacturing back right now, which puts the US in a tough spot. But I like I want to go back a little bit to the faith and confidence in the US government, because that's kind of what backs bonds as well as the FDIC as our deposits in our banks. And so what is the faith and confidence in the US government is that the US government is going to pay back your debt, your bonds, your deposits in your like your federally regulated banks and stuff like that. And from my point of view, I have a lot less faith and confidence in the US government because, one, it seems that the US just pays back all their debts by like printing money, which is it's not good in my eyes, because like my bonds become worth less and less and less over time. Same with the cash in the bank. They become worth less and less over time. And the FDIC is kind of the same way. Like, we have a giant, cushion for depositors. And unfortunately it only goes up to $250,000, which is seems to be an outdated amount, especially for businesses. But like with the SVB example, I've been tracking this, trying to get lots of details on this for the past week or so, because my company had all of our cash tied up in SVB. And so my company, my payroll was at risk. My company was running on the bank based on the advice from our investors, and it wasn't a good situation. And so, but what happened was, luckily I'm getting paid. I got paid, Friday, which was more of a blessing than it normally was, at least from what it felt like. And what's interesting is the FDIC went above and beyond that $250,000 limit for SVB specifically. And there was like $200 billion worth of assets, kind 200 billion worth of deposits essentially in SVB. And many of them were like startups, specifically tech startups. And the FDIC like said, yeah, we're insuring everyone fully, no matter if you were above or below that $250,000 limit. And what that means is, if like that full reimbursement were to go through, which it probably isn't, if the SVB still has assets that they can liquidate and stuff like that at a loss. But what it means is, if we take out $200 billion from the FDIC, that's 20% of our FDIC fund right there. And the SVB was the 16th largest bank in the United States. So if it turns out that regional banks fail, mid-sized banks fail, or whatever, the FDIC, yeah, they can guarantee it. The U.S. government can guarantee that they're going to reimburse all of our depositors. But what are they going to do that? They're going to issue bonds, or they're going to print money to pay back all of that debt, all of those promises that the banks made with the full faith and confidence of the US government, to like pay back all the depositors if they want their money, you know? And that's kind of what scares me right now. Like if we're heading on this road of, yeah, we're going to reimburse everyone no matter the cost, the cost is going to be a lot in terms of the amount of money, whether that's right up front, which will probably happen, or, you know, down the line as we're issuing bonds and then having to repay those like debts later on.
Yeah, and I feel like that's been the trend for and that's what concerns me is how cyclical it's been, because we have debt, external debt to places like China and stuff that we pay off gradually when that is becoming due by basically getting into further debt by issuing bonds. So essentially what the US government is doing is it is resolving. It's almost like if you have a payment due on a credit card that you don't have the money in the bank to pay off. So you're going to pay it with another credit card. And then now that credit card balances. And where are you going to pull that from? Then you got to get another credit card. Or then if you're stuck, then you have to now open a new line of credit to be able to pay that off. And now you're opening up now new credit. So it's like that's kind of what the United States has been doing. It's almost that, but they keep on opening up new credit cards all the time.
And so they're either going to keep opening up credit cards with, I don't know how much credit the U.S. actually has anymore. To me, the U.S. credit is pretty much bankrupt in my eyes. I think that credit kind of is by nature just in the eye beholder based on, you know, the beholder's analysis of a given entity's balance sheet. That's, you know, if you think about it on an individual level, it's kind of what like Credit Karma or banks do to you when they, you know, think about offering you a loan or a credit card or whatever. Like how likely is it that you're going to pay back the debt in a way that the bank sees fit? Like if I was going to pay back my debt in printed money, that's something that wouldn't afford me as an individual much credit, and I don't think that's something that should afford the US government something much credit.
Well, one weird thing is that I just checked the credit worthiness of the United States based on like Fitch and S&P and Moody's and all these other kind of credit assessors. And 2020, they were ranked as AAA rating, which is obviously like really good, but out with a negative outlook. And now they're at AAA by Fitch with a stable outlook as of July 8th, 2022. That being said, that just is marking essentially the United States' ability to repay debts. But that's been forecasted by essentially plotting out future revenue and kind of seeing, how that, at least how the outlook was determined, you know. And I just don't know if I really agree with that, because I mean, at the end of the day, with the middle class being virtually non-existent at this moment in time, I mean, I'll tell you right now, with my income, the amount I get taxed is freaking bonkers. Like for what I earn, like it's nuts. Like I'll tell everybody on the podcast here, I make 85,000 a year, and what I earn, my net income is about, I get like 5,000 a month, so I'm sitting at like 60,000 a year. That's 25K out the door, you know, and that as a percentage of my total is, drum roll please, 30% of my income. That's not good.
Yeah, I'll do a quick calculation. I don't, you know, exactly want to give away how much I make per year, but I am taxed. I'll give you a percentage of how much I take home. I take home 64% of what my income is. So I'm paying 36% in taxes, which, yeah, it's insane to me that the US government can't get their freaking spending in order, given like how much we're being taxed right now.
Right. And honestly, looking back, I think I might edit out my disclosure of my of my salary. Might get that out of there. But agreed, agreed. I think it's kind of wild that they're not able to. Oh, I'm echoing a little bit.
Oh, sorry.
It's just kind of crazy how I just don't see a positive outlook here. Especially with the rate that we're being taxed and the amount of continuous debt that we're taking on, not only internationally but also domestically. I just can't see how the outlook is positive. I would say, if anything, or even stable. I would say turbulent at best.
Yeah, I would 100% agree. It's looking like this podcast is going to be one of those episodes where you and I somehow agree a lot more than usual. It feels like, which that's a good thing.
Yeah, most definitely. Hopefully, months down the road, we're not doing this podcast from Colombia because the United States is just gonzo. That would really suck. So hopefully that's not the case.
One reality I think we should remember is like so right now I've been trying to sound the alarm of like how bad things are actually getting. I think you would probably also agree with this statement. The SVB bank collapse and the other regional banks that collapsed, as well as you saw like the big four banks, JP Morgan and Chase, Wells Fargo, Bank of America, and Citibank, I want to say, all put up $5 billion to fund these regional banks, which indicates to me a broader trend. Like these larger banks, for some reason, have some vested interest in keeping these regional banks alive. Perhaps it's because the big banks own bonds and the regional banks own bonds. And if the regional banks bonds, get liquidated because they collapse and maybe like transferred over somewhere, or I don't know. It would seem to me that the bigger banks' bonds are worth less, right? Because if a smaller bank can't stay afloat because they made bad investments and those bad investments are in bonds, then what does that say for the bigger banks? It seems to me like we're heading into some sort of chain reaction here.
Yes, but I will say I think where we disagree about SVB would be kind of what I was telling you earlier, where I was saying how I think the issue is not. I don't think that SVB is an issue of the U.S. government. I think the U.S. government came into a position where they needed to do something about this, because that's kind of their role in banking. Is because we have private banks, the government's role is very hands off most of the time. They work in conjunction with the banks, but they're not. The banks are not the government. Um, that being said, my opinion as to what could have avoided this SVB fallout from the get go would be increased scrutiny from PE. That's number one when it comes to these new
Can
companies,
you
because that's,
can you specify PE?
yeah, private equity. Private equity needed to kind of, I think in general, I think right now, and I think for the past, like I want to say 10 years, um, the rate at which startups kick off and gain funding it's a very quick time span. And you can get funding for a startup company, especially if it's anything, SVB. So kind of you do anything with the classic buzzwords: software, optimization, blockchain, any of these things, and people will and PE. Like I'm telling you right now, I know people in PE. I'm interested in PE, but you're talking to investors. You're not talking to people within the industry. So it's very easy for people to misunderstand the value and obviously they do their own due diligence, and I think there's problems with that process as well. But at the end of the day, there's a lot of lost in translation going on. And I would say just in general, for every 100 new products made, I would say only about 10 to 15 actually have a significant value brought, value added that can actually bring big returns to the investing company. Most of this stuff is garbage.
Unfortunately, I would agree. Hopefully my company that I work for now isn't in that bucket. We're definitely a startup, definitely in the blockchain, but that's okay. We'll see. But I think part of the reason why private equity was flying into these startups that ended up not making any money, just essentially throwing it and burning it for a little while, keeping the employees warm who worked at those startups is because of the zero interest rate. Money was super cheap to get from banks and then throw at whatever company you wanted to fund. And when a startup like fails, you don't get your investment back. You liquidate whatever assets that startup has, and you get in line with all the other creditors and hope that the creditors in front of you receive all their money, because only if they receive all their money do you actually get any.
Right. It's like a pool of sharks. Like, at the end of the day, it's making a deal with the devil, but it's a necessary evil. Like, you can't really do well as a startup without having some sort of outside investor. You need something, whether it's PE, whether it's angel investing, whatever you need that. But at the end of the day, I think more what I'm saying is this would not have been an issue if there was increased scrutiny from the PE end. And on top of that, I think just like the advantage to a private equity firm throwing funding even at a company that's product is not maybe all that good is that worst case, if you're the first round investor, you liquidate everything and you get everything. That's the advantage. So that's kind of your fail safe thing. But the issue in that, if you're running the bank itself, not on the PE, because the PE side is going to get paid no matter what for the most part. If they're first round financing, they're good. The issue is when you're the bank itself and you are not diversified at all, and all you do essentially is manage the bank accounts for these startup companies that have just all this outside money being pumped in, just given the life cycle of a business, the first step is very much withdrawing and expenses. You're very expense heavy for the first couple years, essentially, until your product kind of matures or your service matures. So the fact that they are not diversified and they are essentially just running with these startups in full confidence that these startups will do well and that they will start reinvesting that money that they're pulling out back into the bank, and they have no sort of ratio set for how much money is supposed to be in the safe as opposed to how much is being put in from essentially being wired from private equity firms. What are you doing? Because it was something that was written it was written in the stars. It was bound to happen from the beginning. Because if you do that, and half these companies are garbage and they're crap and they're not going to end up doing anything, they're very expense heavy. Next thing you know, they flop over and then they're pretty much getting cut apart for the different pieces of meat that the PE firms can get. How was this ever supposed to end in a good way? It is dependent on money being cheap to borrow. That was the dependency that would lead to SVB's success. The minute interest rates get high, what do you think? Now, what's your move?
And so this kind of, like, I had a thought while you were talking about like why the bigger banks would have a vested interest in these smaller banks like SVB not failing. And it would seem to me like if I'm a private investor, like trying to fund a startup, likely something that I would consider, and I don't know if this is standard practice. You'll have to fact check me on this. But what I would do is, I'm a private investor. I've made a lot of money. I have a lot of cash in the bank. But what I would do is, if I want to fund a startup if I want to put $5 million in, probably what I would do is I would take $2.5 million of my own money and then maybe get a loan from a bigger bank that would take me as a debtor, right? Because I've made money. I have cash in the bank. I have a history of paying back loans. I would take like 2.5 million out of a big bank, and then, put those two together to fund the $5 million in the startup. And so when a smaller bank like SVB fails, those deposits in there are like, some of those deposits are from bigger banks, and so maybe that kind of shows why these bigger banks, like, the big four, are putting up $5 billion to keep the smaller banks afloat, because maybe they're not the first in line to get reimbursed,
Well, and there's vested interest, and that, right? That's why there's private equity groups within those big commercial banks as well, like J.P. Morgan, Bank of America. They have their own PE branches that are drawing upon, like you said, they are basically taking bank money from the bank, from the overall bank, and basically reinvesting it in here. So that would make sense as to why they're so heavy in bailing this out. Because, like, hey, you know what? Like, we have vested interest here. We have money here. That a lot of our PE clientele are all, basing and putting their deposits into SVB. We have stake here. But the issue is that the brunt of the responsibility falls upon the due diligence not being done, and B, the actual SVB itself. Like, I get the advantage for a startup for why you'd want to bank SVB, but at the end of the day, it's just, I don't know. In my mind, I think it was kind of doomed to fail from the beginning. And I think that it was just an inevitability that now we're all, panicking. Oh no, this happened, all this stuff. But at the end of the day, the United States a lot of these startups provide absolutely zero value. And at the end of the day, if that's the case, and you have all these crap startups that are mixed in with really high value startups at this bank that is encouraging startups to essentially pull out a lot of money, which they're going to do anyways, then it's, I don't know, it's just doomed from the start. Whereas I think a system like China, last thing I'll say is, like, there's a startup in China, there's a lot of red and yellow tape you got to go through to be able to actually do these things. There's very deep assessments of credit worthiness, borrowing, spending, registering the company, doing all these things to basically make sure, foolproof, that this company provides value and it will not fail. There's no liability. So
stepping back, it seems like what we've discovered about this SVB situation, there's a lot of moving parts here. There's a lot of moving parts, a lot of individual people making decisions that makes this whole picture very, very complicated. But trying to simplify it, for the past 10 years, we've had like historically low interest rates, like near 0%, which has made money cheap and which has led to loans being made that shouldn't have been made. The loans have been made to non-creditworthy companies, especially like in the tech industry in Silicon Valley, which is probably why SVB failed. However, so that's kind of like the US government's, the US Fed's responsibility, sort of, in addition to the investors who got the loans from the big banks and put up that loan and their own money into those non-creditworthy startups. So that's US government, individual investors not accounting for like not being able to see the writing on the wall of like poor like national fiscal policy. The second thing is, we see a similar dynamic happening in the management of SVB itself. And this is like, so this kind of, these facts I'm going to lay out right now come from like the All In podcast. That's a, honestly, it's like four guys who are deeply involved in tech. They're kind of like those private equity investors you were talking about. But these guys were saying SVB itself, like, one, they knew that they had a bunch of startup depositors. So these startups, especially in the early stages, they aren't bringing in money, especially when we're talking about the tech industry, tech startups. They aren't bringing in very much money for like the first, like, I don't know, 5 years. that they're around, maybe more. And it's a lot of speculation. And so during those like 5 years, the early stages, they're taking a lot of capital out because also tech is expensive. Like paying software engineers is expensive. It's a skill that costs a lot of money to get, and it's a skill in high demand. One of the things SVB did wrong was they invested incorrectly uh, in respect to the like overall kind of fiscal climate of the past like 10 years. So we saw near zero interest rates. So SVB decided apparently to put a lot of their money into like really long duration treasury bills. So like those treasury bills wouldn't mature until like 10 years down the line. And if you take the money out before the bills mature, then you're going to lose money, especially when interest rates go up very, very quickly like they did in the last like year or two. And so that's what kind of led to the cash squeeze. The bad balance sheet that led to the bank run was SVB's failure to realize how quickly money was going to be flowing out versus how much was going to be coming uh, in terms of like are investors going to be putting more money into the bank because they're funding more startups? Obviously we see that's not the case because of the higher interest rates. And now all this financial shenanigans, like, investors are going to hopefully be even tighter with their money. But there was that like time duration mismatch of SVB's investments where I think they had 200 billion in deposits, and by the time the bank run happened, they're if they liquidated at the time of the bank run, they would have had 170 billion in like total cash, which 30 billion is a lot of money missing. So
Yeah, 100%. And I would say the one last piece, and I'm in full agreement here. I think the last piece, though, would be relating to just the nature of startups now and talking about how, again, most of them are technology oriented, kind of as you mentioned. A lot of these startups, especially at SVB, I mean, just look at the name, Silicon Valley Bank, dude. Like, it's tech startup after tech startup, And at the end of the day, from a financial perspective, when you're trying to, from the viewpoint of the private equity group, it is very, very difficult to assess the resources and capabilities and just overall fair market value for a startup company in tech. Reason why is because that tech, whatever thing that there's software that they're introducing, it is not tied to any sort of tangible assets. Same thing goes with blockchains. And there's no tangible asset you can tie it to. It's technically considered an intangible asset. And the difficulty in intangible assets, it's almost like trying to assess what the dollar value of American work ethic is. We don't know. You can try, but you're not going to get it. And at the end of the day, that's another big piece of it, because not only, and it's tied into the actual overall economy, but the fact that we don't know how to valuate these companies. And if you don't valuate the company properly, then you're possibly giving way too much money than is actually needed for that startup, way too much risk involved, because tech by nature, it's intangible asset, but on top of that, it's very volatile, very risky. Could be very high reward, but given just the quantity of tech startups there are right now, I don't know. And I think it goes back to the due diligence, but even with due diligence, it's really hard to even just assess what the value of these companies is. So I think that's another kind of piece that, might have caused for these, for that mismatch in deposit to actual cash held, like being held is actually like how that happened. I don't know. There's just so many different facets of this. So many different pieces that you can just keep diving in forever, pretty much.
Yeah. So I think that gives a good idea of kind of how we think about the world, like how we think about the world economy, the US economy, and how money comes into the system, how it goes out, where how it gets transferred to different people, different entities. But one of the things I think we should like kind of step back and get back to the core of the podcast is ask, okay, how would Ray Dalio look at a situation like this? Like, and I think in chapter 3, we see Ray Dalio talking about the long-term debt cycle. And I would make the case that Ray Dalio today would say, yeah, we're looking at the end of a long-term debt cycle, and we've got to somehow make our way back to the beginning of the long-term debt cycle where money is like tied to the real economy in a much more like concrete way. And so the way that Ray Dalio makes the case is money becomes from like a fiat system to a hard money like gold or silver or whatever, like a tangible asset. And so one thing I wanted to do real quick is go through the 6 stages of the long-term debt cycle. And I don't know, maybe just talk about it a little bit. Does that sound good?
Let's do it. As the kids say, let him cook.
So long-term debt cycle, the 6 stages starts on page 116. And we see stage 1. Stage 1, the long-term debt cycle begins with A, little or no debt, and B, money being hard. So this essentially is pretty self-explanatory. Like if we go back to the like I don't know, like after the Great Depression, I feel like the Great Depression was kind of the end of a long-term debt cycle and the beginning of a new one. That's like when we went to when we went back to the gold standard up until like 1970. So I think that's generally a good marker of kind of like a long-term debt cycle that we can kind of use as an example. And we saw the end of the Great Depression. I don't exactly know how much debt the US had after the Great Depression, like after World War One, I guess it was. Our money was certainly tied to gold, and yeah, there is a lot of value in that. And Ray Dalio describes it as gold can be used as both a safe medium exchange and a safe storehold of wealth because it is a part of the real economy, not just this kind of ethereal monetary economy that tracks the transfer of goods in the real economy to some extent.
So I just looked it up. So it's saying from 1930 to 39, which was kind of start of the World War II in Europe, I guess specifically. But debt jumped by 150%. By the end of it, it was around 40.44 billion, which in today's money, 673 billion.
So essentially no debt, right?
Right.
So very, very little debt. So I think if we, the question was, can we use end of the Great Depression to now for a long-term debt cycle? I think it's fairly valid to say, yeah, we can.
But we just have to assess the other factors involved because Great Depression, United States, like kind of we mentioned earlier, very isolationist, like wasn't really involved in foreign dealings. Like we weren't really trading much with anybody else. Like most trading done was domestically, stocks, companies, like domestically. We didn't really diversify internationally at that point. So there were less, I guess, there was less debt, but also less avenues for revenue. So just like a quick call out there.
Okay. So that makes sense. So stage one, beginning with little or no debt and money being hard. So this is like trading, it seems, with actual physical gold. Stage two says, then come claims on hard money, i.e., notes or paper money. And so this is, correct me if I'm wrong, kind of like gold backs, essentially. Like you print $1 and you say you're going to be able to get half an ounce of gold with this dollar. Like there's a specific tie to like the asset that backs the money. And so these are kind of like promises of physical assets that you can like gauge your dollar on. And that's a lot different from today, right? We see our fiat currency is like not tied to the dollar and or any asset, it seems, except for the full faith and confidence in the US government. So in stage two, I see some bold text. It says, soon people treat these paper claims on money as if they are money itself. And it goes on to say, after all, they can be redeemed for tangible money or used to buy things directly. This type of currency system is called a linked currency system because the value of the currency is linked to the value of something, typically hard money, such as gold and silver. So that I think describes to some extent like how the US dollar was after the Great Depression. Like I believe during the Great Depression we unlinked, we had to print a bunch of money to pay back debt and like put it into like war efforts and stuff like that. But after that time period, we went back to the gold standard. Like $1 is worth some amount of gold as guaranteed by the government.
Well, we also took a bunch of money and essentially money we didn't have and reinvested it into social programs, which long term created more value than it costs. So that's why it kind of worked out. Like Medicare, Medicaid, like it all kind of worked out. But we were already cash strapped, and I don't know if it was a genius idea or a really risky one, but he just decided let's take more money and pump it into social programs to create jobs and bolster, kind of give a little jump start to the U.S. economy to see if that would work. And it was a gamble, but it paid off.
And I wonder if that describes stage three, which says then comes increased debt. And it goes on to say, at first there are the same number of claims on the hard money as there is hard money in the bank. Then the holders of paper claims and the banks discover the wonders of credit and debt. So holders of paper claims loan them to banks in exchange for interest payments. The banks like to do that because they can lend the money to others who can pay a higher interest rate, allowing the banks to make a profit. So I don't know, that kind of, I don't know if that exactly describes what you just said, like the social programs and stuff that didn't really come from the banks versus maybe the banks buying government debt to fund the
Well, the
social
government, I
programs.
think what it was is the government borrowing, and it was the government stepping in for the banks, because a bank is not going to be able to create some sort of social service program. So the government pretty much borrowed, to the best of my understanding, borrowed to be able to do so that there would be more job creation and wealth creation. And also they added the social security component, which was essentially allowed for the government to tax more on it in the promise of social security when you're older. So, yeah, that's what I know about it.
Okay. So stage 3 goes on to say more lending and borrowing happens over and over again many times. There is a boom in the quantity of the claims on the money, i.e., debt assets, rises relative to the amount of actual goods and services there is to buy. Eventually, the claims become much larger than the actual hard money in the bank. And then in the bold text, trouble approaches when there isn't enough income to service one's debts, or when the amount of claims people are holding in the expectation that they can sell them to get money to buy goods and services increases faster than the amount of goods and services by an amount that makes the conversion from the debt asset impossible. These two problems tend to come together. So I feel like we got to break that down. I got kind of lost in that sentence. So trouble approaches when there isn't enough income to service one's debts. So income meaning an entity isn't producing enough goods and services relative to the amount of debt it has or the amount of debt it's taking on. So that kind of goes back to what we were saying, right? Like the real economy with the denominator of the monetary economy, like if those two aren't increasing in the same amount, then like your your fraction is decreasing in value. It's no longer a 1-to-1. It's like a 1-to-2, 1-to-3, 1-to-4, you know?
Right.
And then the other problem is so there isn't enough income to service one's debts. Second problem is when the amount of claims people are holding in the expectation that they can sell them to get tangible assets increases faster than the amount of goods and services. So the debt is increasing faster than the amount of goods and services produced. So, I mean, this makes sense as to why the two problems are kind of interrelated, right?
Right. Mm, but one thing also that I find interesting is the fact that like debt is not always a bad thing, because at the end of the day, there's an immediate benefit to going into debt. So just like with a credit card, the advantage to having a credit card is to increase your buying power. So debt is not always bad. Sometimes you need to use to leverage that debt to be able to fulfill other obligations. But like it says, it's when that amount exceeds the income that you have at your disposal, because then now you're at risk for defaulting on said debt. But I think that statement, I'm just reading it. The paper claims and the banks discover the wonders of credit and debt. Yeah, and I think that we can see that now with banks kind of really liberally issuing. Like I remember just to get this car recently, the Capital One gave me an approval like right off the bat. Didn't even think about it. They were like, "Yeah, yeah, we'll loan it to you. No worries." Yeah, yeah, because at the end of the day, they're so liberal with it because they're starting to realize that because the interest rates are so high right now, they don't need to think twice about it. So they are discovering, like Dalio says, discovering the wonders of credit and debt. So, and I think that that's more applicable on the individual level than it is on the grand scheme. Like when you talk about individual consumer level, because like anything when it comes to these people who can't afford the car that they're financing or whatever, like then a bank is more than happy to issue that debt because they know it's going to probably default and they know that they're going to be paid a ton of money out for it. So I don't know. I guess that's the only add-on I had there. I also need to plug my computer in. So
Okay, well, I keep talking if you want to go find a charger. One of the other things after these bold letters on page 118 in stage 3 we see is Think of debt as negative earnings and a negative asset that eats up earnings, and in parentheses, because earnings have to go and pay the debt. This debt also eats up other assets because these other assets have to be sold to get the money to pay the debt. And when we're talking about a currency linked to an asset like gold, we know this is true because like those are the only ways to do it. Either you have to go get more gold to trade in for cash, like produce your goods and services, or you have to sell other goods and services to get money. And there's no other way around those two things, because the money is linked to hard assets, and you can't go and like produce more money without producing more of those hard assets. So and Ray Dalio recognizes that point, and it says when you can't earn enough, when you can't sell enough assets, there needs to be debt restructurings in which debts and debt burdens are reduced, which is problematic for both the debtor and the creditor because one person's debts are another's assets. And so you can do debt restructurings and or the central bank printing money paired with the central government handing out money and credit to fill in the holes in incomes and balance sheets. And so when that happens and the central government also isn't going and finding more gold to back all the dollars they're printing, that's when we kind of dive into the realm of inflation and um, a currency that's no longer linked to gold, the asset that kind of makes it trustworthy in a way.
Yeah, I wanted to chime in on your statement that your liabilities are someone else's asset, because it's the truth. And at the end of the day, when you like what might happen in the next coming months if interest rates are essentially lowered across the board, that would, if we're talking about issues with the banking system, that would even further hurt the bank, because at the end of the day, banks profit a lot off of times like this, because this is where people a lot of the time need to borrow more money. So now is their time to basically cash in on that. And if you restructure the actual interest rates, now you're undercutting their earnings, and the actual value of the money lent and the value of the money that they're being paid back, it's it's not what they initially negotiated. And that would lead to a lot of liquidity problems, I think, down the road with the banks if the Fed does something to the interest rate. And if they manipulate it in any sort of way. I mean, it would be helpful for the end consumer, but for the actual banking system as a whole, I think that they would see some serious losses, for not only that quarter, but likely for the entire, probably span the entire fiscal year, given the duration of their outstanding contracts. So just kind of wanted to chime in there and say that.
Okay. I think that makes sense. And so stage 4 is the debt crises, defaults, and devaluations come, which leads to the printing of money and the breaking of the link to hard money, which I just said. So that, I mean, stage 4, that's been happening for a while in the U.S. I feel and so stage 4 out of 6, that's nearing a little bit past the halfway part of the 6-stage cycle. And if we look at 1970, when the US went into the state of fiat currency, that sort of, to me, represents stage 4 of this long-term debt cycle. I don't think this time is linear, though. Like if we saw the Great Depression, which was the end of like the last long-term debt cycle, that fiat currency came about, and then stage 5 and 6 came about really, really, really quickly. And right now we've kind of been sitting in stage 4 for the last like 50 years, it seems like. But so some bold print in stage 4. Private banks must either default or get bailed out by the government when they get into trouble, while central banks can devalue their claims, for like e.g. pay 50 to 70% back if their debts are denominated in their national currency, which is I think is the picture I've been trying to print with inflation. Like if you have $1 million in debt and you only have $500 million in the bank, or if the central government has $1 million in bank, $1 million in debt and only 500 whatever in the bank, they can print the 500 million to and by effect they're only paying back half of it because all that money is worth half as much. You know?
Right. I'm trying to visualize what you just said there.
So the central bank, let's say they like 10 years ago, they sold $1 million in bonds, and now the time has come to pay back that $1 million in full. And let's say they only have 500,000 in the bank, in the central bank. What they could do, and what Ray Dalio says happens in a stage 4 long-term debt cycle, is that central bank prints the remaining $500,000 that they need to pay back that $1 million in debt, and by effect, they're only paying back 500,000 real dollars, because the 500,000 that was paid back is kind of printed money and is just it's like more IOUs. Like there wasn't actual real value associated with that $500,000 that was printed. It was just printed in order to say we paid back $1 million, but you know.
Yeah, but I'm seeing here, I'm also thinking that either they would print it or they would refinance it to an extent, where they would pretty much extend the duration of the loan period and the interest payments. But again, that's putting a band-aid on the issue, because either way, you're putting a band-aid on the issue because you owe that money. And yeah, you can renegotiate the contract, or you could just print more money and put it down and it's worth half as much. But at the end of the day, the root issue here is the fact that the government is assuming debt, that, just to kind of put it back in the broad perspective, because I feel like we've been, getting pretty deep in the weeds, which is good. But I think, just to kind of reiterate, the issue is the fact that the government is unable to satisfy the demands of existing debt contracts, pretty much. That's the big issue. So what do you think then what is the best way in your situation, where it's, they have $1 million that they need to pay off? How would they do that the right way?
I mean,
It's a tough, it's a thinker.
it's a tough question. Like I don't likely the right answer is if you don't want to put the whole burden on whatever creditor you're paying back, the right answer is to both refinance and print money, which I think is what kind of the end of stage 3 talks about. When that's not enough, there needs to be A, debt restructurings, a refi, or B, the central bank prints money. I don't know that there's other options other than like maybe selling central bank assets, like maybe I don't know. The only like I don't know actually what the central bank holds other than debt. What assets they hold, but um, maybe they hold some assets, and they could just say, like an asset, for example, could be, oh, this other person owes me $500,000, so in like 2 years, so I'll pay you the 500,000 I have now. I'll give you this future credit from that this person was supposed to pay me in 2 years, and in addition, I'll print $100,000 to pay you, um, to cover your costs within that like 2 years of of payment. You know what I mean? That's my best guess at the right answer. I don't think there is a right answer though. Like this situation is that we're in right now is so much worse than that. Like,
Yeah, and the issue is that like there is no right answer, like you said, and at the end of the day, it's almost like again back to kind of what we said earlier. I owe credit card payments here. I have a revolving balance. I need to pay off this balance, but I don't have the money in the bank. What do I do? Do I basically, because you can get a temporary loan to basically cover all of your existing, what do you have, like your payments. So you can get like, if you owe 10,000 on across all your credit cards, you can get a $10,000 loan to pay that off in the immediate, but then pay off that 10,000, or you open new lines of credit to pay off that 10,000. Either way, you are going to owe significantly more money. And when you look at it from the perspective of the US government, you're going to be owing significantly more money in the future. And at the end of the day, the issue is, why are we assuming this debt, knowing that why are people even issuing debt, knowing the liability of the government not being able to repay it?
yeah, and I think that's kind of the long-term debts, like that. No, well, actually, a better description of this is the short-term debt cycles that are within the long-term debt cycle, that eventually so much debt builds up that there isn't enough stuff in the real economy to like cover those debts. Like, no matter who the debtor or the creditor is, like there's just not enough value being produced, and that's, I think, where the end of the long-term debt cycle is. That's why eventually the debt just has to go to zero. You just have to be like, that it's just unfeasible. We've got ourselves in a situation where it's like there's no way out of it other than everyone loses.
Right, defaulting. That's it. Bankruptcy and defaulting. And the day that the government goes bankrupt, hopefully it's not soon, but that's going to be it's going to be a pretty devastating blow, not only to, us Americans, but also to the rest of the world too. There's going to be big ripple impacts across borders because of just how globalized everything is, and especially how diversified and international portfolios the U.S. government and U.S. based banks are. So I think that it would have severe blowback. So I think that's also why a lot of foreign entities like China and stuff are very not complacent, but they're very lax about the repayment of these debts, is because they know that there's going to be blowback if they default. So I think that's another kind of piece.
Yeah. And I'm seeing in stage 5, after the printing of fiat money, Ray Dalio describes 4 levers that policymakers can pull to bring debt and debt service levels down relative to the income and cash flow levels required to service debt. The first lever is austerity, or spending less. 2 is debt defaults and restructurings. 3 is transfers of money and credit from those who have more than they need to those who have less than they need. For example, raising taxes. And 4 is printing money and devaluing it. So I think we pretty much hit 3 of those levers. Um, I don't think we ever spend less, though. I think that's a very foreign concept for U.S. policymakers.
I think just Americans in general, we don't know how to not spend. You know.
I would agree. So, let's finish this up. Stage 6. Then the flight back into hard money. So Ray Dalio says when taken too far, the overprinting of fiat currency leads to the selling of debt assets, the cashing in of debt assets, and the earlier described bank run dynamic, which ultimately reduces the value of money and credit, which prompts people to flee both out of currency and the debt. And so I think that goes into the point we've been making. Like this happens when there isn't enough real economy to service the debt that is built up um in any sort of like meaningful time period in any like human lifetime, and so everyone flees, and I don't know if there's a soft landing.
No, because at the end of the day, especially for the people, for folks who are in debt, it's not like that debt's gonna just go away. Because at the end of the day, you're going to have to once those assets, well, like for example, like the gold example or silver, like if you're in debt, that debt is not going to go anywhere at the end of the day, unless the actual financial institution collapses. And even then, you're still in a bad spot because you have no real assets. So yeah, I wonder how that. I think that the damage is going to be a lot harder on again the individual and household level than it will be on the actual on like a corporate level. I think a lot of big companies are probably going to feel it a lot, and I mean, but I think that in general, companies are structured in a way to kind of hedge against these kinds of risks. And they already are diversified internationally, and that's like one of the biggest ways to hedge against this. But when it comes to the individual level, I think that a lot of and just given kind of the trends of U.S. household spending and debt levels, I think that people are going to be very poor here if that happens. I think a lot of the country will be very poor. But that's kinda how we started off, so it might be just back to square one, honestly. So, you know?
Yeah, man. I mean, when the US dollar becomes worth nothing, kind of the currency will just be purely determined by hard assets and by what all of the depositors feel is actually worth something. So like, you know, certain goods and services are worth something. Food and guns and ammo, especially, will be worth something. Gold and silver will likely be worth something. Uh, and I think that's kind of why uh, after the end of a long-term debt cycle, that's why we go back into hard money, because the like once the people alive see that the fiat money is actually worth nothing because all the fiat money that they once held is worth nothing, then they give value to whatever they decide to exchange in, and that becomes the new currency. I think it's kind of like a self-fulfilling prophecy. One thing I wanted to point out, which I really like when Ray Dalio says stuff like this. This is on page 128, end of stage 6. Ironically, the closer most people are to the blow up, which is also when the claims outstanding, when the debt outstanding are largest relative to the amount of hard money and tangible wealth there is, the riskier the situation is, but the safer people tend to feel. And that is because they have held the debt and enjoy the rewards of doing so. The longer it has been since the last blow up, the more people's memories of it have faded. And so that's one of the things that kind of scares me about this most recent like financial thing. Like uh, it the FDIC, as far as I'm aware, FDIC insuring the totality of SVB's deposits is more of a psyop than anything. It's more of like, let's bolster confidence in what people think is valuable, the US dollar, because if the people don't think it's valuable, then it's not valuable. It's fiat, right? It's just psychological, and the rhetoric, the narrative around this financial thing, like it's a little too hopeful in my opinion. And I think it goes into kind of what Ray Dalio was saying here. Like people just think it's going to be fine because it's been 75, 80 years, almost 100 years since the last blow up. So everyone's memory is faded and, oh, we made it through the blow up in 2008. So it's going to be fine. But whenever people say that, it just makes me think like the US dollar hasn't been around for all of human history. Like it isn't just going to be fine. It odds are, like if we think about the US dollar as just any other global reserve currency, we know that it isn't going to be fine. Every other global reserve currency isn't around anymore. Or if it is around, it's worth a lot less. So it makes me a little more trying to like aware, or makes me try and be more aware about this latest financial mishap.
Yeah, and I think it's also, I mean, kind of like we mentioned earlier, I think it's I think my little piece would be that I think we're kind of moving towards a single banking system again. Um, and there's advantages and disadvantages to that. But I think that just given the level of acquisitions that have happened recently, and consolidating kind of IOUs and outstanding obligations, I have a feeling that that's what the government and banking systems see as the likely temporary fix to this. But the issue when you have a single banking system is that you can't split it up after it's one. So that's where I think we're going. And I think a lot of people, like you said, I'll go right with you. I think they do feel way too safe about this. But that being said, I think that there are options. There are options here. And
Let's talk about our options.
well, I mean, more in the fact that we're not a third world country tied down by obligations to China or some other, like we're not in like Central Africa, being pretty much all of our money coming from China. Like we have trade relationships. I think it's just a matter of kind of going back to basics, for lack of a better term. Like kind of we mentioned earlier, like starting to invest more internally, even if we don't really have the money to do so. Continuing with rebuilding and building infrastructure in the country, jobs which are available now. Jobs are not the issue. I would say self-reliance, especially one really overlooked area is not just industry, but agriculture. It's huge. It's one of our biggest things that we export is food.
I would second self-reliance. I would in fact third self-reliance. I think if you as an individual can produce concrete value for someone else, whether that's in the form of goods or services, uh, that is certainly something we should like focus on more as we go into this. Like I think a good example of not being self-reliant is taking on like debt from the bank right now, you know. And I don't think there's like you shouldn't take debt from the bank right now. I think in certain cases it makes sense to do that if it especially if it helps you create like goods and services in the near term. For example, um like buying a car. Like I think it makes sense to get a loan from the bank to buy a car because if you're getting the car for the right reasons, you can get to work easier. You can like you know, at a worst case, drive people around. You know, there's a service right there. You know, um, for me, my self reliance looks like getting out of debt as much as possible. After SVB, I made my own little bank runs, and I'm getting as much as I can in as much as makes sense. You know, just staying diversified to some extent into gold and silver because that's a hard good. That's a hard asset that for thousands and thousands of years has always had value. Um, and its value can be tracked over time in terms of other goods, and it normally stays the same. You know, obviously, I think gold has just as much value on a desert island as like a dollar would, but um you know, in terms of like the ability to transfer goods and services easily between some sort of population of people, some sort of like fluid economy, like gold and silver is a pretty reliable way to do that because you can't print those things. It's really hard to get. It's really hard to purify. It's really hard to manufacture. And it's rare, you know,
Yeah, I would say gold, silver, oil, and food
and guns.
and guns. So I guess let's go in with some. You want to start off with a little closing remark here? Any thoughts? Anything dying to get out?
Um, you know, my only closing remark would be that, you know, I'm getting into the hard assets, and that's going to be something that is very, very hard to do if people start losing faith in the US dollar, if you live in the US, that is. So if like you know, and I think I'm taking this a little bit to an extreme because my company was directly impacted by SVB, and you know, while we still have access to our money right now, you know, I'm not bought in to the full faith and confidence of the U.S. government. I know, for example, that the U.S. government doesn't really have much faith anymore in terms of the whole God thing. Uh, and my confidence certainly isn't there. I'm pretty confident they'll keep printing money. So, um, you know, I'm trying to bring my wealth into non-US dollar things right now, and that's kind of my main closing remark. I I guess one other thing I'll say is I also think we're heading into one central bank system based on kind of it's a mixture of the globalist kind of agenda that and kind of direction that the world has been taking, that individual countries have been taking. There's a lot of obvious benefits to being in a globalist society, especially when it comes to trade. I don't think one of those benefits is going to be a central global financial system. I think that is what leads to the inflationary spirals and some of the famines described in the book of Revelation, as well as the mark of the beast, which is something that makes you lose your eternal salvation with Jesus. So that's the second part of my global remark, my closing remark.
I guess for me it would just be more of a encouragement. I know I've struggled in the past, and I'm trying to take care of debt obligations that I have, because obviously we all have our different circumstances, and not just outside things that are affecting our lives, but also our weaknesses, and stuff that maybe if you're not a spender, if you're a spender, but either way, I think my steps here are really to just try to handle these short-term debt obligations, try to get those closed out, and Spring's a sponsor of the video, Microsoft Excel. Use it for your spreadsheets, use it for your whatever you freaking want. They actually did not sponsor this video, but um, create a spreadsheet, budget some stuff out. It's important to handle these short-term debt obligations because rates are ridiculous through the roof right now. I saw like American Express. I saw a screenshot the other day. This guy was getting like 35% APR. It's absurd. It's absurd. So it's like, take care of those debt obligations because it does add up. And in my mind, I think the order of things should be number one, savings. Number two, short-term debt obligations, credit cards, these sorts of things. Number three, investing. And then number four, anything after that. I think this should be those three. You should first have you need money in your savings account, easy pull out, money right there. Take care of the credit card payments, short-term debt obligation. Make sure you're making payments on time. Even if you don't have all the money to make cover it all in full, make payments. Make sure that you are in good standing. And three, once you have the money and you've satisfied those debt requirements and you have money dedicated to your savings that you continuously pump in, then put money into investing. I think a lot of people are really advertising investing like it's a solution for everything, which it is not. It is not. You need to satisfy your short-term debt obligations. Those are not going to go away just because you put $200 into Microsoft. So satisfy those and move on from there. So that's just more of an encouragement for people to keep me accountable here in my in all of our journeys here financially, so that our asses are covered when the time comes. If the time comes. But yeah, all we can do is take care of ourselves and focus about what we can do to change our own spending habits. And what the government does, unfortunately, we the people don't have much to say about that. So yeah, so make sure that you're in good standing, make sure you're taken care of in your family, and after that, you can't really control it. So yeah, that's all I had to say, really. But
Well, with that, this is Two Guys, One Book on Ray Dalio's principles for dealing with the changing world order. We're here on chapter 3 and 4, the financial series. So we'll probably be, again, sitting here a little while. And yeah, we'll talk soon. We'll be back.
we might have a guest the next time we see each other. So strap in.
Hopefully.
All right, signing off.